So, should we buy or sell this bond market ETF? First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So, we are talking about the US Aggregate Bonds ETF, 4.55% away from the 52-week low, minus 11% away from the highs. So we start here with the charts, weekly data points. So if we zoom in a bit, we do see that there's a very interesting move in development. So this purple 20-week moving average is a very big deal. Bears love to come there and short. But there's a big but, because this has also been a support level in the past. So while the bears are currently definitively shorting that moving average, um, if the bulls were able to break out above it, then we would have bears closing out their short positions. Looking at the daily data points, the blue 100-day moving average is just a beautiful level here for the bears. You see back here in November of 2021, easy surgical short. Here in early December 2021, super easy, perfect short. We see here that the bulls are very close to testing that moving average. What happens at that moving average is a huge deal. If we do see rejection, then I guarantee you there will be big bears just shorting and shorting. However, if we were to see the bulls break out above it, and preferably close above it, that would make numerous bears get very sweaty. Certainly, if I was, short the AGG and I saw a breakout, I would not feel that comfortable. I would reduce my position, tighten my stop, maybe even hedge. Okay, so here are the weekly data points, and we do see a nice bullish buy signal here on the MACD. We did get a very strong buy signal here. This is back in 2021 during this rally. And after that buy signal, you had multiple months of us going up on the AGG. So definitively, this move on the MACD could become self-reinforcing. Still very early, but definitively interesting development. Looking at the daily data points, so when it comes to the RSI here and also the 20-day PPO in purple and also the green 50 daily moving average PPO, we are at a level that has triggered pullbacks in the past. So back here in July of 2021, these readings they did form highs. So that is an issue for the bulls. Looking at accumulation distribution, it is pretty bearish. There is a bearish divergence here between price and volume. So I do write here 20 weekly moving average resistance and -6 on the technicals. But there's a big but. This is, of course, based on the current situation. The bears have a very easy trade here. However, as I said, if the bears were to lose this resistance level, then this -6 is not going to be a -6 anymore. Then the bears will be in the trouble they haven't been in a long while. Let's look at the seasonality. So the seasonality to the right here is rather bearish. In green over the last 5 years, 7 the last 7 years, red the last 10 years. The seasonality is rather bearish heading into late September. To the left over the last 5 years, the seasonality from July to August, September gets worse, meaning more bearish. Over the last 10 years, from July to September, we definitively see a weakening here. However, we are still in July and it closes higher 80% of the time. Big picture, the last 20 years, July is a very strong month, and yes, we are still in it. August closes higher 67% of the time, so it is bullish. September is a bit mediocre, but this is basically a question of whether you want to look at the longest term, seasonality, or shorter term. The seasonality data we did get here was certainly more bearish for the coming months than bullish, so the bears do get a -4 here. Let's look at the fundamentals. So I am comparing the aggregate bond ETF with the total international bond ETF. Let's go to performance. So year to date, pretty close to each other. When we look here at the yield, 2% versus 1.12. So the AGG definitively delivers a significantly bigger yield. Number of holdings is very substantial. So you got some BlackRock funds, treasury bonds, you got some treasury notes. So here you can see the breakdown. So sovereign bonds is 42%, mortgage-backed security 26%, corporate bonds 13%, so a nice mix. So the type of person that wants a yield is way more likely to pick the AGG instead of the BNDX. Another thing, when it comes to fundamentals, you get much more diversification with the AGG. So this looks good from a more fundamental perspective. Let's look at relative performance. So we do have long-term weekly data points, -25% with the S&P 500, 90% positive with BNDX, the one we compared it against on the fundamentals, -72% with the dollar index, and -95% with the 10-year yield. So yes, the 10-year yield and the AGG, they do move opposite each other, but it's not a perfect negative correlation. There is like 5% here that is not based, due to the yield. Here we have daily data points. So you do see that there's 86% positive with S&P 500, 98% with BNDX, 91% negative with the dollar index. And here you can see, the 10-year yield. And there's been various periods here in 2020, as you can see, and also in 2016, when, yes, there was a negative correlation between the AGG and the 10-year yield. But here, as an example, it was -68% here in February of 2016. So that is very far from like a very strong, negative correlation. But sure, what happens with the 10-year yield is going to have a very substantial effect on the AGG. So here is the 10-year yield weekly data points. We have seen a very, very strong move to the upside, but we have recently seen a bit of a pullback. Going here to the daily data points, there is an interesting development because you see here that this blue 100-day moving average. Let me just draw in where it was support. So 100 daily moving average in blue, clear support, super buyable, buy. But yeah, what was support has now become resistance. So given the very strongly negative correlation with the 10-year yield and the AGG, the 100 daily moving average becoming a resistance level could become very interesting. It could become rather bullish for the AGG. Here is the relationship between the AGG and the 10-year yield, and we are at a very low end of the range. You could make a pretty decent case that this looks like a horizontal support level. So that could become rather beneficial for the bulls. It means that we could enter a period where the AGG starts to outperform the 10-year yield. Looking at RSI, we have fallen down to a low end of RSI that many times in the past has formed lows. Other times where we touched the low end of RSI, we got substantial long-term strengthening of the AGG, even getting into overbought territory. Doesn't mean that it will happen again, it just means that more often than not, it did happen. The seasonality, on the other hand, here is very favorable to the 10-year yield. The AGG usually weakens against the 10-year yield all the way here into early November. So I give the bulls a 6 here on relative performance. So we do end up with a 0.3 in favor of the bulls. The problem for the bulls is that the 20 weekly moving average resistance is still very much in play. So let's look at some alternatives to the AGG. The classic, of course, is the TLT, the 20-year Treasury Bond ETF. We can see that this ETF, it does have a bit of a history here of successful double bottoms. Here you got the double bottom that worked. Here you got the double bottom that worked. Here you got the double bottom that worked, at least a bit. Maybe this right here is a substantial double bottom. The problem with the right end of this double, well, the most recent double bottom is that it is lower than the left, so it is not like a clean textbook double bottom. Here is C-Bond, that is the China Bond ETF. So yeah, in this case, it's a bit messy because the 200 weekly moving average, as you can see, let me draw it in, resistance, resistance, then it became support, and that was of course bullish, but we have recently sliced and diced that moving average, and when that happens, it loses legitimacy, it becomes less tradable. Looking at daily data points, it seems like, let me draw it in, that the green 50 daily moving average is rather tradable. It was very buyable back there as support, very shortable as resistance here, as you can see. So yeah, the green 50-day moving average is definitively the level to watch here for the China Bond ETF. Yeah, we are now below it, so yeah, the bears have made a bit of a power move. Here is the Global X Super Dividend ETF. So buying dividend stocks, it has been used as an alternative to the bond market, to get that yield. In this case, yeah, we have a very messy chart here. So let's look at the dailies. We are heading into a horizontal resistance level. So just rather messy. Let's look at PFF. That is the Preferred and Income Securities ETF. Also a bit of a, bond yield alternative. Yeah. I mean, we have fallen below a bunch of horizontal support levels. That is an issue. We are heading towards a moving average resistance level here. The purple 20-week moving average is coming back here again. Looking at the daily data points, yeah, the blue 100 day is where it's at. Looking at RSI, we are at a prior fail level. So this rally failed at the current level. This rally also failed. Well, that was actually a bit lower, but this rally here in late 2021 also failed at this RSI level. So because of that, the people who bought and are buying this rally, I mean, they are sitting on some decent profits, but you also need to consider their psychological frame here, because they will look at RSI and tighten their stops, because they want to hold on to their profits. So you get, short sellers trying to use the high RSI level, but you also have bulls who have made money that will be happy selling at that resistance level. So it's messy. But yeah, this is a bit vulnerable here. But yeah, we have looked at a bunch of stuff now. To get more data, just go to diamondarm.com. I am currently on a holiday, but I did have an opportunity here to set up my stuff and record a video, well, 4 videos. So, yeah, have a fantastic week ahead and always use stops and never accept any big loss.